Hello, this is Samantha Shares. This episode covers NCUA's new proposed rule on proposed rule incentive-based compensation arrangements voted on at the July 18th board meeting. The proposed rule passed by a vote of 2-1. The following is a word-for-word real audio of that item. This podcast is educational and is not legal advice. We are sponsored by Credit Union Exam Solutions Incorporated, whose team has over 240 years of National Credit Union Administration experience. We assist our clients with NCUA so they save time and money. If you are worried about a recent, upcoming, or in-process NCUA examination, reach out to learn how they can assist at marktrickle.com. Also check out our other podcast called With Flying Colors, where we provide tips on how to achieve success with NCUA. And now the NCUA board.
The second item of business today is proposed rule incentive-based compensation arrangements, 12 CFR parts 741 and 751. Staff presenting are John Berry, Policy Officer, Office of Examination and Insurance, and Gira Bose, Senior Staff Attorney, Office of General Counsel. Staff available for questions include Amanda Parkhill, Deputy Director, Office of Examination and Insurance, and Ariel Pereira, Senior Staff Attorney, Office of General Counsel. Good morning, John, Gira, Amanda, and Ariel. John and Gira, you may begin whenever you are ready.
Thank you, Chairman. Good morning, everyone. Chairman Harper, Vice Chairman Hopman, and Board Member Otska. We are here today to present for your consideration a proposed rule entitled Incentive-Based Compensation Arrangements to fulfill NCUA's obligations under Section 956 of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Section 956 requires NCUA and 5 other agencies, the Federal Reserve Board, Federal Deposit Insurance Corporation, Office of the Comptroller of the Currency, Securities and Exchange Commission, and Federal Housing Finance Agency to jointly prescribe regulations or guidelines with respect to incentive-based compensation practices at certain covered financial institutions. Specifically, Section 956 requires that the agencies prohibit any types of incentive-based payment arrangement or any feature of any such arrangement that the regulators determine encourage inappropriate risks by covered financial institutions. One, by providing an executive officer, employee, director, or principal shareholder of the covered financial institution with excessive compensation, fees, or benefits. Or 2, that could lead to material financial loss to the covered financial institution. Section 956 does not apply to institutions with less than $1 billion in assets. It does not require a financial institution that does not have an incentive-based payment arrangement to make the disclosures required by Section 956, and it does not require the reporting of the actual compensation of particular individuals. To date, the agencies have issued 2 proposed rules, one in 2011 and the second in 2016, neither of which were finalized. This 2024 action is being taken by NCUA, FDIC, OCC, and FHFA. It involves reissuing the 2016 proposal for public notice and comment and requesting commenter input on alternatives that may be incorporated into a final rule. I'll now turn it over to John to discuss the proposal.
Thank you, Gira. Good morning again, Chairman Harper, Vice Chairman Hoffman, and Board Member Otska. I would like to briefly summarize the contents of this proposed rule. The proposed rule identifies 3 levels of covered institutions subject to the rule. Level 1 institutions are those with assets equal to or greater than $250 billion. Level 2 institutions are those with assets greater than or equal to $50 billion, but less than $250 billion. And Level 3 institutions are those with assets greater than or equal to $1 billion, but less than $50 billion in assets. At this time, there are 449 federally insured credit unions that would be covered by this rule, with 447 being a Level 3 and 2 being a Level 2. We would have no Level 1 credit unions. As noted earlier, this proposed rule prohibits incentive-based compensation plans that provide excessive compensation or could lead to material loss at the credit union. The proposed rule contains 6 factors for determining whether compensation is excessive or unreasonable or disproportionate to the value of services performed by a covered person. These factors apply to institutions at all 3 levels. The factors must be considered are the combined value of all compensation and fees or benefits provided to the covered person, the compensation history of the covered person and others with comparable expertise at the credit union, the financial condition of the credit union, compensation practices at comparable credit unions based on such factors as asset size, geographic location, and the complexity of that credit union's operations, and for post-employment benefits, the projected total cost and benefit to the credit union, and any connection that covered person has with any fraudulent act or omission, breach of trust, or insider abuse with regard to that credit union. The proposed rule contains three key principles that must be considered when determining if incentive-based compensation poses a material risk of loss to the credit union. The principles applied to this institution at all three levels and include whether the incentive-based compensation arrangement appropriately balances risk and financial reward, whether the incentive-based compensation arrangement is compatible with effective risk management and controls, and whether the incentive-based compensation arrangement is supported by effective governance. With this proposal, the agencies expect that a covered institution would tailor its incentive-based compensation program to its size, complexity, risk tolerance, business model, and the business model of the institution, consistent with the previously listed factors. The proposal requires that an institution's board of directors or a committee thereof be directly involved in the oversight of the incentive-based compensation program. Specifically, the board of directors or the committee thereof must approve all incentive-based compensation plans for senior executive officers, including awards and payouts, and approve all material exceptions or adjustments to plans covering senior executive officers. The last core requirement of the proposed rule involves record keeping. All covered institutions will have to document their incentive-based compensation plans, maintain them for 7 years, and provide them to the regulator upon request. At a minimum, records must include copies of all incentive-based compensation plans, a record of who is subject to the plan, and a description of how the plan is consistent with effective risk management and controls. The proposed rule applies additional, more rigorous prohibitions and requirements to incentive-based compensation arrangements at Level 1 and Level 2 credit unions. These enhanced requirements include coverage of individuals considered to be significant risk takers, as well as the senior executive officers, enhanced disclosure and record-keeping requirements, deferral of a portion of qualifying incentive-based compensation in accordance with the rule, the requirement that unvested deferred incentive-based compensation be at risk of downward adjustment or forfeiture under certain circumstances set forth in the rule, and inclusion of clawback provisions in qualifying incentive-based compensation arrangements, and independent risk management and control requirements, and enhanced requirements relating to governance, policies, and procedures. Finally, the rule provides an implementation timeline of 18 months. It grandfathers existing plans for the life of those plans, and it also provides an 18-month window for institutions newly subject to the rule to comply. In other words, if a credit union surpasses $1 billion in total assets at a later point in time, that credit union will be afforded the same 18-month period for implementing the required provisions of the rule. This concludes our comments. We are glad to answer any questions that you have.
Thank you. Thank you so much, Gira and John, for your presentation on this proposed rule to implement the incentive-based compensation requirements of Section 956 of the Dodd-Frank Wall Street Reform and Consumer Protection Act. More importantly, thank you for your work on the interagency team of federal regulators that developed this proposed rule. And thank you, Amanda and Ariel, for being available to respond to any questions that we may have. I know that this is a complex topic. In just 3 days, we will mark the 14th anniversary of the enactment into law of the Dodd-Frank Wall Street Reform and Consumer Protection Act. And this September, we will mark the 16th anniversary of the collapse of Lehman Brothers and AIG, both prominent events in the financial crisis and the Great Recession that followed. The Dodd-Frank Act responded to those events and, among other things, called upon financial regulators to act on the issue of incentive compensation within 9 months of enactment. So it's an understatement to say that this rulemaking is long overdue. It's actually an incomplete assignment about which lawmakers frequently inquire of me at hearings. They want to know when we are going to finish our homework. For me, the time to act is now. Specifically, Section 956 of the Dodd-Frank Act requires federal financial regulators, including the National Credit Union Administration, to issue joint regulations or guidelines requiring disclosure and reporting of incentive-based compensation for senior executive officers and significant risk takers at financial institutions with more than $1 billion in assets. It also requires us to establish a mechanism for deferring income and clawing back improper gains resulting from excessive risk-taking when an institution fails. As noted earlier, the proposed rule we are considering today is identical to the proposed rule recently approved by the Federal Deposit Insurance Corporation, the Federal Housing Finance Agency, and the Office of the Comptroller of the Currency in May. This rule also reproposes the regulatory text issued in June 2016 and seeks public comment in the preamble on certain alternatives and questions. As in 2016, the proposed rule would establish a three-tiered system for covered financial institutions. Level 1 would cover institutions with $250 billion or greater in assets. Level 2 would cover those institutions between $50 billion and $250 billion. And Level 3 would cover institutions between $1 billion and $50 billion in assets. From the perspective of federally insured credit unions, the proposed rule's impact is relatively small. As of the end of the first quarter of 2024, there were no federally insured credit unions in Level 1, as John noted in his remarks. There were two credit unions that were Level 2. One had $50-some billion, and one was at $170-some billion. And then there were 440-some credit unions in Level 3. As such, the vast majority of credit unions, in fact, more than 90% of credit unions, would be exempt from this rule. Critics of this proposed rule will say that it shouldn't apply to credit unions, but the statute is clear. The rule must apply to credit unions with $1 billion in assets or more. Critics of the rule might also claim that credit unions were not responsible for the financial crisis or the Great Recession. The agency, however, cannot change what Congress required. Credit unions with more than $1 billion in assets are covered by the law. That point is clear. Some may also claim that credit union compensation practices are different from other financial providers. That may largely be true, but there are clear examples of excessive incentive-based compensation contributing to the failures of consumer and corporate credit unions nearly 16 years ago during the financial crisis. A prime example of that is the failure of Cal State 9 Credit Union. That failure cost the Share Insurance Fund more than $170 million. Moreover, the material loss review of Cal State 9 found that, quote, an incentive compensation program that paid nearly $400,000 in bonuses to the credit union's CFO between 2006 and 2007 based on net income generated by the credit union's home equity loan program was one of two factors that contributed significantly to Cal State 9's excessive concentration of assets and indirect home equities lines of credit that eventually led to its demise. In another example, Western Corporate Federal Credit Union pursued a strategy of generating more interest income than would be available from deposits it held. Westcorp used this income to pay high rates on its member certificates and to generate increased net interest income to support operational expenses, including providing substantial compensation increases for its executives. Between 2002 and 2008, the total annual compensation for the leadership team increased by an average of 88%. These executives pocketed enormous profits while the corporate's members and ultimately the credit union system bore the cost of Westcorp's failure. To help avoid similar situations in the future, the NCUA is required by Congress to issue a joint incentive-based compensation regulation or guidelines, and that is what we are doing here today. Some may also assert that we have learned our lessons and what happened in 2008 cannot happen again in 2024. I wish that were true, but it is not. Just last year, we saw how excessive risk-taking by certain banks rocked our financial markets. As noted in the proposed rule, a report on the failure of Silicon Valley Bank, for example, noted that the compensation packages of senior management were tied to short-term earnings and equity returns did not include risk metrics. That same report concluded that the bank's managers had a financial incentive to focus on short-term profit over sound risk management. A consistent set of enforceable standards across financial regulators would level the playing field, avoid regulatory arbitrage, and help ensure that incentive-based compensation arrangements at covered financial institutions are not excessive and do not lead to material financial losses. Lastly, some may assert that in passing Section 956, Congress allowed the agencies to issue joint guidelines instead of a rule. That is correct, but guidelines are an imperfect solution in this instance as they are unenforceable. We cannot cite guidelines in documents of resolution. and in the event of future failures resulting from excessive greed, we will lack the regulatory structure and authority needed to claw back excessive gains. I know the need for these reforms from firsthand experience. As part of my work in helping to draft this financial reform provision, it was clear then, and it's clear now, that Congress and the American people want senior executives, wrongdoers, and fat cats at large financial institutions held accountable for any irresponsible and damaging business practices. Greedy executives should not earn excessive bonuses while taxpayers foot the bill when their institutions fail. This rulemaking effort is about providing transparency and accountability. This regulatory effort will better focus the leaders of financial firms on the long-term health of the company instead of just their short-term personal gain. That's good for the credit union system, it's good for our financial markets, and it's good for the Share Insurance Fund. For these reasons, I strongly support this proposed rule. That concludes my remarks. I now recognize the Vice Chairman.
You bet. Thanks for the presentation. Quite a bit of effort. There's four of you here. How many folks were involved in general in preparing for this presentation today?
Yeah, I can answer
for the
that.
board meeting.
For the board meeting, well, there were four individuals that were involved in the interagency meetings and in assisting with the development of the rule. Three from the Office of General Counsel and one from the Office of Examination and Insurance. And then our work was subject to higher-level supervisory reviews.
For the board meeting specifically, not just the rule itself.
The same individuals.
Same group. I remember when I had a briefing on this, there were 11 staff members besides my staff. There were 11 on the call. I say that because I want to note that work for this meeting could have been avoided. I offered to address this item via notation vote if my colleagues would support halting the publication of each credit union's total income from overdraft and NSF fees with the name of the credit union next to it. I suggested NCUA examiners could still have access to that data, and we could publish various forms of aggregate data, 20th and 80th percentiles, that sort of thing. My suggestion was rejected, all to maintain a policy that still, as of today, lacks any legitimate justification. As you might expect, law firms are already positioning themselves to extract more settlements from the institutions we insure, which is a very odd thing for NCUA to promote. To today's rule on incentive compensation, I can't support it because it exceeds what Congress mandated and does so in an intrusive and harmful manner. There was a better way to do this. I want to quote FDIC Vice Chairman Travis Hill, who already voted against the same proposed rule, as his comments echo my own. Begin quote. In 2010, the banking agencies issued guidance and adopted a principles-based approach to help ensure that incentive compensation policies do not encourage imprudent risk-taking. Notably, the 2010 guidance asserted that a principles-based approach is the most effective way to address incentive compensation practices, given the differences in the size and complexity of banking organizations covered by the guidance and the complexity, diversity, and range of incentive compensations arrangements by those organizations. The guidance established expectations that incentive comp would balance risk and financial results in a manner that does not encourage employees to expose their organizations to imprudent risks. And it provided different options that banks can use to make compensation more sensitive to risk. Overall, implementation of the 2010 guidance, along with other supervisory engagements around that time, contributed to meaningful change in incentive compensation practices across the industry. And the incentive compensation arrangements that were cited by some as a factor in the financial crisis are far less common today, end quote. One of the reasons, if you notice the dates of that 2010 guidance, was the agencies, including this one, were trying to head off Congress mandating something clunkier. Congress did at least, we can't say guidelines. We didn't have to do a rule. The agencies, including NCUA, could have used that guidance as the foundation for a six-agency effort to satisfy Congress's directives. Let me ask you this. If we compare this proposed rule today to the principles-based approach in the 2010 guidance, which method is likely to create more opportunities for enforcement actions?
Yeah. Thank you, Mr. Vice Chair. I can answer that. So just as initially, I would just note that the NCUA was not a party to the 2010 guidelines. Which was
as the banking regulators. That's right.
The other banking agencies.
I'll want to correct my remark. It was the banking agencies on that, yeah.
But to answer your question, in general, guidelines or the standards set by guidelines are not directly enforceable, whereas those contained in a rule are. So by the fact that this is a proposed rule, and if it's finalized, it would establish binding requirements. The final rule would be enforceable in a way that the guidelines are not.
Well, obviously, rules can create enforcement actions in a way that guidance doesn't. But particularly going from a principles-based approach to this one with a lot more paperwork has to be done correctly. Remember, you can get dinged just for not doing the paperwork right, regardless of any actual harm done. But if you put it this way, if you are one of the agencies on this and you wanted all else equal enforcement actions, you wanted the press releases, you wanted to report the dollar amount collected, which approach would yield more, number of enforcement actions and dollar amount? That Principles 2010 approach or this prescriptive rule today?
It's hard to say, Mr. Vice Chair. The fact that we weren't part of the 2010 guidelines, I mean, we haven't.
No, I'm not asking whether we're part of it or not, but we know they exist, and we know they significantly reduce the type of incentive comp that some say contribute to the crisis.
It can vary. Sometimes a principles-based approach can lead to less enforcement actions, but sometimes it's just by their very nature, principles-based can be less specific, and so they're much more open to subjectivity and interpretation, and so it's hard to say. Without looking at the specifics and doing that sort of side-by-side comparison, it's hard to say that one necessarily would lead to less enforcement actions than another.
I would say the history of financial regulation, especially from non-insurers, is the more rules and the more prescriptive they are, the number of enforcement actions goes up. What I'm getting at is the incentive problem here. Government agencies face incentives, and we're not examining those today, and I'll talk about that in a minute. We're not mandated to by Congress either, but it doesn't mean it's not something to think about. The incentive to have enforcement actions. If you don't have profit, it's power, publicity, prestige, and in some agencies, post-employment job opportunities. The harsher your enforcement actions and the harder it is to follow, the higher the market value for former regulators. I would say that if you look at, in the long run, you can predict exactly what agencies do if you look at those incentives in front of them. So we have an incentive problem here that is, I think, harming the American public. Let me go back to this. There's unnecessary language about extending these burdensome requirements to credit union service organizations, QSOs. Question, did Congress mandate that?
I can take that question. No, Congress does not mandate that the rule or guidelines or however the agencies want to implement the statute apply to QSOs. But what Congress does say is that the agencies should decide, they have discretion to apply the rule to any other financial institution that they determine should be treated as a covered financial institution under the rule. And to be clear, QSOs are not included under
as covered financial institutions.
As covered financial institutions.
Software providers are not considered. Because if you consider them a financial institution, then, boy, there's a whole lot of financial institutions in this country.
Financially insured credit unions would be regulated under this proposal.
Right. But it mentions credit union service organizations, and we are not their regulator.
And they're not covered under this rule.
But there is language, the word QSO is in there?
You cannot do through a QSO or any other entity, if you are a credit union, what you cannot do directly under this rule. So there is an anti-evasion provision. And I think you may also be getting at the fact that there is a question in the preamble with regard to QSOs. It's a long-standing question. A similar question was also asked back in 2011. And that's an opportunity for the agency to get feedback on QSOs and to...
But
in the event that the board wants
the word credit union service organization is not in Section 956 of Dodd-Frank.
No, it's not, and it's not in the regulation either.
All right. I asked our staff to eat our own cooking here because, remember, we can't say we're here to do this. Well, Congress mandated it. No, they did, but we know there's other ways to do it. When this agency and the other agencies are party to it, and by the way, this will not become law probably any time while I'm here because the Fed opposes it, hasn't not approved it yet. Flat out opposes it. That's why this is not going to go in the Federal Register. But since we went well beyond what Congress said, we can't complain that it's too burdensome. I asked the staff to eat our own cooking. I said, let's put ourselves in the shoes of a large credit union and mock it up. See what you would do, right? How long does it take, et cetera. A large credit union would have to comply with this and actually write up what you expect them to report to us just to get a handle on it, right? Remember, no one on earth understands this more and doesn't have to interpret it more than the people who wrote it. They're the only people, as of today, that actually have to know exactly how to do it, right? We don't have to interpret it. There are words. So this should be the easiest possible thing, right? The only people who know exactly what it means. No interpretation, no guidelines, and don't actually have to get in trouble for doing it since it was just an exercise for doing it poorly. I think it's crucial for government to understand what it demands of others. I've said it before, the only people who think compliance is easy are the people who don't have to do it. Here's what I received after some time was spent in this exercise. Altogether, this exercise took 3 team members approximately 20 hours to complete, including drafting, revising, and clearing the materials for 1 employee. Creating the initial template for the annual incentive-based compensation plan for the CEO took 3 hours, and completing the annual review took 1 hour, which we believe is accurate for similar. This is for 1 human being, okay? And remember, we're the ones who know the rules the best. We wrote it. 0 interpretation needed on it. So that's quite a bit of time and effort, and it doesn't even include the stress level associated with you actually having to submit it to your regulator. Finally, the incentives for regulators need examination. I've mentioned this before. In the long run, the agencies will act according to its incentives. Those incentives, in the absence of a profit motive, are power, publicity, prestige, and at some agencies, are post-regulator job opportunities. The harder the regulations are to comply with, and the harsher the enforcement, the higher the market value is for former regulators. Government agencies should examine their own incentives and ensure they align with that of the American public. I would extend the same thing to government as a whole, not just agencies, since political interference in the housing market was a leading cause of the crisis. People got political benefits for themselves, forcing everyone in this room to back over half of the subprime mortgages that existed via government entities, whether we asked for them or not. They got benefits for themselves, and the rest of us paid the cost. Government interference in the housing market was key, and that is an incentive issue that some might consider important as well. That concludes my remarks.
Thank you so much. Thank you so much, Board Member Otska.
Thank you. Thank you to the staff for your presentation and all your work on this rule. I really appreciate it. Finalizing this rule is a long time coming. As Chair Harper noted, this Sunday marks the 14th anniversary of the passage of the Dodd-Frank Act. In other words, for over a decade, the federal financial regulators have failed to implement this crucial regulatory tool that Congress specifically tasked us with doing. Hopefully, we are on the way to changing this as the NCUA joins the FHFA, OCC, and FDIC in reproposing this rule today. I urge our colleagues at the SEC and the Federal Reserve to do the same. As many of you have heard me say, 2 of the defining moments of my career were working in the aftermath of the global financial crisis and dealing with the failure of Silicon Valley Bank and the other 2 banks that failed that spring. In both cases, we saw bank CEOs get paid millions as their banks failed, often in the form of bonuses or incentive-based pay. If your institution fails on your watch and you still receive your incentive-based pay, I am not sure what exactly you're being incentivized to do. At the time of its collapse, SVB had over 30 unresolved supervisory warnings. Still, its CEO, Greg Becker, received a $1.5 million bonus as part of his 2022 compensation package that was worth about $10 million in total. Many of us also vividly remember when Wall Street CEOs still got their bonuses, even as their companies needed billions of taxpayer rescue dollars to stop the bleeding during the financial crisis. We as regulators need to be able to ensure that incentive-based pay actually incentivizes prudent management and aligns with safe and sound banking practices. In the credit union space, we are seeing both a rise in total executive pay and incentive-based pay. Data from the 2023 CUE's executive compensation survey show that executive pay among credit unions has increased on average by 8% from the previous year. Industry experts have noted that historically credit union CEO pay grew annually by 3 to 4%. The survey also showed that bonuses account for 20 to 25% of the total compensation for executives at credit unions. Another industry survey published in 2022 showed that 25% of CEOs at credit unions with over $1 billion in assets receive long-term incentives, up from just 10% of CEOs in 2017. And the number of credit unions with assets equal to or greater than $1 billion are increasing at a steady rate. Between the year 2000 and March of this year, the U.S. has gone from having 43 credit unions with over $1 billion in assets to 443. In the last 5 years alone, we have seen 133 credit unions cross the $1 billion asset mark. Given these trends, it makes perfect sense that the rule would only apply to the largest credit unions, those with $1 billion in assets or more. These are not necessarily small credit unions with just a handful of employees and volunteers. Frankly, the leadership at many very small credit unions are probably not getting paid enough. This rule would apply to some of the most complex credit unions whose mismanagement or failure could send shockwaves through the entire credit union system. And, we are not just required to do this rule. The reason we're doing this rule is not just because Congress required us to do it. It is because we do have a duty to protect the share insurance fund. And we need to issue rules, not because we are worried that institutions might get dinged or might have to do more paperwork. Those are considerations. But it is important for us as a regulator and insurer to have enforceable rules that protect the share insurance fund. It's good for the system and it's good for the American people and taxpayers. This rulemaking coincides with the fact that we are experiencing a wave of retirements in our leadership ranks among credit unions, and those credit unions need to be able to attract and retain talent. Offering incentive-based pay is one way to do so. And in that sense, it is fitting that we're voting on both the succession planning and incentive-based pay proposal today, as both rules provide additional stewardship as our credit union system continues to grow. To that end, the proposed rule aims to put more safeguards in place to ensure incentive-based pay is aligned with the proper incentives, such as sound governance practices and risk management controls. It includes prohibitions intended to make these compensation arrangements more sensitive to risk, such as banning incentive pay that does not include risk adjustment of awards, deferral of payments, and forfeiture and clawback provisions. These provisions would help safeguard credit unions from the types and features of incentive-based compensation arrangements that encourage inappropriate risks. We want credit union management to be adequately compensated and be able to attract and retain talent. I do think that's important. I think it's important for leaders of financial institutions, including credit unions, to be adequately compensated for what are very hard and increasingly complex jobs. However, it is our job as a regulator to ensure that credit unions are doing that in a prudent way to protect our system of cooperative credit. So for these reasons, I strongly support the re-proposal, and I really thank staff for all the hard work that went into it.
Thank you very much. Board Member Otska, is there a motion?
I move that the board approve proposed rule, incentive-based compensation arrangements, 12 CFR Parts 741 and 751, for a 60-day comment period as attached to the board action memorandum.
Is there a second? Hearing none, I second the motion. All those in favor say aye. Aye.
Aye.
All those opposed say nay.
Nay.
The ayes have it, and let the record show that the motion passes to.
This concludes this item. If your credit union could use assistance with your exam, reach out to Mark Treichel on LinkedIn or at marktreichel.com. This is Samantha Shares, and we thank you for listening.